Hey guys, welcome to today's video. It's the first on our brand new web series called Retire on Rails. The series is all for digital nomads, by digital nomads. We're going to take you through some financial planning lessons. Some of this is real traditional stuff, but we're also folding this in with a 2021 modern digital nomad application. So we're going to be going through some real life scenarios for you, which really should help you get to retirement early using the FIRE model, fixed income, retire early. A lot of you guys out there have already done really well, so boom to bust. So you might have already been a crypto kid who's had 7-figure returns. You might have an e-commerce platform that's giving you a really good residual income, or you might even be a diamond fist who's holding tons of GameStop. Or alternatively, you might just be starting out and looking for some basic advice. So this series, once again, is going to be for you. It's not to be taken as financial advice. This is simply me giving some of my education out there. If you are going to be taking on some financial advice or doing some investment, please make sure you speak to a professional. So let's get started. A little bit of history about myself. So I have studied financial planning in 3 different jurisdictions now. I studied it with the Chartered Institute for Securities and Investments, which is UK based. I've studied in Australia with Kaplan, and I'm currently studying with Solomon in the USA. So I've got a pretty broad range of financial planning knowledge because it comes from 3 different schools. And my background is in e-commerce. So I work for a car company in Australia called Holden. I work for the City Holden dealer network doing e-commerce before e-commerce was really a thing. This is going back years and years ago. Basically teaching dealerships how to sell cars online, how to do stock price matrixing, how to handle the data, how to get it out to the salesman. So that's my background, guys. So I really hope you enjoy today. Today's lesson is a really important one. This is why it's the first lesson. It's something that I wish I had have not learned, because I learned it early on, but I just didn't put it into practice. It's one of those things where for some people, you kind of have to learn by your mistakes, but don't do that. Learn from my mistakes. I'm going to tell you the mistakes that I've made before, using Tesla as an example, and then showing you how you can actually use that model to make yourself some really good money. And if you do this right, this is going to help you retire early. So let's get your retirement on rails going, and let's get started with today's lesson. Okay, so you're either going to walk away with today's lesson learning one of the core fundamentals if you're an amateur. Even if you're a professional, you probably should watch this video again just to give yourself a bit of a reminder. Cool. If we want to be binary, there are 2 different kinds of investors. There are day traders who might be trading 2 or 3 times a day, buying, selling, looking at resistance measures, Bollinger Bands, candlesticks, opens, closes, all these kind of things. If you don't know what any of those terminologies are, then don't worry. You probably fall into the majority category, which is the buy and hold traders. So people who look at different sectors, such as, say, electronic vehicles, renewable energies, biotechnology, and buy into those messages. Biotech, CRISPR at the moment is amazing. 3D printing is coming up, automation and robotics. There's a whole heap of areas people are looking at, esports as well. So if you fall into that category, which is probably the 95% plus, this lesson is for you. If you're a day trader, good luck to you. It's not something that I do myself because it's just too easy to lose money and you miss out on tons of gains. This is how you miss out on those gains. Let's have a look at the calendar above us. If we took March 2020, geez, 2020, what a crazy year with COVID and all that. This is what it did to the market. So if we look up here, Thursday the 12th was the worst day in the markets in 20 years. But Friday the 13th was the best day in 20 years. If we go back to 2015, if we look at August, the 24th of August was the worst day of the year, and the 26th of August was the best day of the year. So what we know now is that typically in markets, the best days of the year always follow the worst days of the year. Now, the funny thing about data is how you can make things support your own argument. You can pick your data points to prove pretty much anything you want. For this sake, what if we just avoided the 10 worst days historically? Well, you would have actually performed much better than just participating in the best days. So kind of leads you to the argument, well, why don't we just avoid or just miss out on the 10 worst days? Well, for this reason, you don't have a crystal ball. Remember that one. Market crashes are much like car crashes. They're quite often fast, unexpected, and catastrophic. You won't ever get a warning on Bloomberg in the morning going, oh, there's going to be a market crash tomorrow. So the first thing to understand is that even the very best experts in the industry, guys who trade for a living, never can predict the exact date the worst days are going to happen. So by the time the worst days are upon you, the damage has already been done. So also remember that the best days quite often come after that. So here's how the scenario will typically work out for you. You wake up, you read the news, the market is down 9%, and everyone is talking about how catastrophic it is and how this is the end of Rome. Everything's burning down. I can show you some clips from back at the crash in March of 2020 when all the Wall Street guys are going, this is fundamentally changed. The world is never going to be the same. Sell everything, basically. So you make the smart decision and you sell your stocks. And in the next day or two, you miss out on the gain. So this is more likely going to mean that you're not only not timing the correctly on the way out, you'll also miss the next jump up in stock prices. So this is the very definition of sell low, buy high, which is the opposite of what you want to be doing. Let's use Tesla as an example here, and also as an example of why you should always be in the market. So this is Tesla from January 2019 to February the 14th, 2020. Now, Tesla, you want to buy some Tesla, but it's already gone up 151%. You say to yourself, Tesla's too high. It's too expensive. I've already missed out on the boat. It's gone up 151%. It's never going to, it's always going to go down. It's never going to go up. I kind of missed out on the Tesla investment. If we look at the red line, that's the S&P 500 as a comparison, which has gone up a respectable 31% over the same period. So Tesla is now in a bubble. Okay, now let's look at the next chart. This is from that same date, February 17th to February 17th to March 16th is the next one. So now Tesla has gone down 44%. So now Tesla is actually a good time to buy. But also, if you're already buying Tesla, your 150% is now 110%. So you're going, oh, geez, maybe I've made 110%. I should be selling now. I've had a good run of it. Tesla's over. Porsche is going to take over, or BMW, or whatever reason it is you tell yourself that the game's over and, time to get off the Ferris wheel. And so you do that. Now, if you had have done that, you would have missed out on this one, which is taking Tesla, the final chart, from February 17th, 2020 to February the 2nd, 2021, which is as of today's date. Okay, now Tesla has actually done 395%. So close enough to a 400% gain. And we see back there that what is now a little dip. So this is the exact example of why you buy and hold. Have diamond fists, don't have paper hands, don't sell out, as long as the company has good fundamentals. So that's the lesson. If we look at it on chart, so let's look at the last 20 years, what would have happened. This is the final chart, guys. I'm trying to make this as quick and as painless as possible for you. So if we look at this, if we had have stayed invested, so this is from January 1st, 1980 until the 31st of September. This is the S&P 500. If we had have remained, put $10,000, that's it, $10,000 in on day one. If we had have stayed invested, our $10,000 is now worth a whopping $952,000. Great. If we had have missed out on just 5 of the best days, that $950,000 is now worth $590. If we had have missed out on only 10 of the best days, our $950,000 is now only worth $425. That's just missing out on 10 of the best days in the market. So that means you would have lost out on 55% of your retirement. So this is a lifetime of investing, and you should be invested for your lifetime. And the difference in walking away with $68,000 if you'd missed out on 50 of the best days versus $952,000, which is a retirement pot for you. So that's why this is such an important lesson. Don't do my mistake, which I did mistake on Tesla. I made some pretty good returns, but I missed out on the bulk of the money. Learn from my mistakes, put this to practice. Time in the market is always better than time in the market, guys. And that's the first lesson. Hope you enjoyed. Click the like button and subscribe if you want to be watching the rest of these series. Should be pretty good, guys. Thank you very much for watching and have a good day. I'll leave you with a final little caveat on this, which is readjusting is fine. And what I mean by that is there would have been a time in history when selling your horse and buggy stocks to buy motor vehicle stocks would have been a good idea. There was a day when selling your blockbuster stocks to buy some Netflix stocks was a good idea as well. So don't beat yourself up too much for readjusting, but make sure you're doing it for a good reason. That's the caveat on this. Everything else, stay in the markets. Thanks, guys. Have a good day.